Day trading looks exciting. Fast charts, quick profits, big opportunities. But here is the truth most beginners need to hear. Day trading is not easy money. Most people lose because they trade emotionally, use weak strategies, or try to compete with professionals who have faster systems, better data, and more capital. I am Barry, a certified financial technician, and in this video I'll explain what day trading really is, whether it is legal, whether it is gambling, what day traders look for, the biggest risks, and why I believe pattern trading is the most realistic strategy for retail traders. Let's start with the basics. What is day trading? Day trading means buying and selling a security within the same trading day. That could be a stock, ETF, option, future, or currency pair. The goal is to profit from short-term price movement before the market closes. Instead of holding a stock for months or years, a day trader might hold it for minutes or hours. But a moving stock is not automatically a good trade. A real day trade needs structure. I need to know why I am entering, where I am exiting, how much I am risking, and what I will do if the trade moves against me. Without that plan, day trading becomes guessing. And guessing is where most traders get into trouble. What is the best software for day trading? Good software helps day traders find opportunities faster. The most useful tools include charting, scanning, alerts, pattern recognition, and backtesting. In my testing, TradingView, TrendSpider, and Trade Ideas are some of the strongest platforms for retail traders. TradingView is excellent for charts, alerts, scripts, and broad market coverage. TrendSpider is strong for automated technical analysis, pattern recognition, and backtesting. Trade Ideas is focused on AI-driven scanning and short-term trade ideas. But software does not make you profitable by itself. It only helps you find and test opportunities. The real edge comes from discipline, risk control, and a repeatable strategy. Is day trading legal? Yes, day trading is legal. You can buy and sell securities within the same day through a regulated broker, but legal does not mean safe. Day trading rules depend on your country, broker, account type, and whether you use margin. In the United States, the old pattern day trader rules are being replaced by newer intraday margin standards. So before trading actively, always check your broker's rules. Because one mistake with leverage or margin can create losses very quickly. What does pattern day trading mean? Pattern day trading traditionally meant making frequent day trades in a margin account. This used to trigger stricter account rules, including the well-known $25,000 minimum equity requirement. But the practical lesson is still the same. Know your account rules. Know whether you are using margin, know how much risk your broker allows, and never trade more frequently than your capital and risk plan can handle. Day trading is not just about finding setups. It is also about understanding the rules of the account you are trading in. Is day trading gambling? Day trading is not automatically gambling. The difference is process. If I trade with a tested setup, clear entries, clear exits, position sizing, and stop losses, then I am following a trading system. But if I chase candles, revenge trade, double down after losses, or trade because I feel bored, then it becomes gambling. Day trading can feel like gambling because the feedback is immediate. You enter a trade, and within minutes you can see profit or loss. That creates excitement, fear, and temptation. And that is why beginners often overtrade. They think more trades mean more opportunity, but most of the time it means more mistakes, more costs, and more emotional decisions. What do day traders look for? Day traders usually look for volatility, liquidity, volume, and a catalyst. Volatility gives the stock room to move. Liquidity helps traders enter and exit. Volume shows real market interest, and a catalyst explains why the stock is moving. That could be earnings, breaking news, analyst upgrades, economic data, or sector momentum. But I do not want to trade movement blindly. I want structure. That means support and resistance, breakouts, reversals, trend lines, chart patterns, and volume confirmation. The best trades happen when multiple signals line up. What are the risks of day trading? Day trading is risky. You can lose money quickly, you can overtrade, you can use too much margin, you can get trapped in illiquid stocks, and you can make bad decisions because of fear or greed. The biggest risk is often psychological. Day trading forces fast decisions under pressure That can lead to revenge trading, panic selling, oversized positions, and ignoring stop losses. Retail traders are also competing against institutions, algorithms, market makers, and high-frequency trading systems. So if I day trade, I need strict risk controls. Can you make money day trading? Yes, you can make money day trading, but most people do not. The data shows that only a small percentage of day traders are consistently profitable after costs. That is because day trading has hidden friction. Spreads, slippage, commissions, platform fees, data costs, and poor timing all reduce returns. Even several small wins can be wiped out by one large loss. So day trading should not be treated as easy income. It is a high-risk, high-skill activity. To have any realistic chance, I need capital discipline, emotional control, tested setups, and the right tools. How do day traders find stocks? Day traders find stocks using scanners, watch lists, news feeds, earnings calendars, and technical screeners. They look for unusual volume, price gaps, breaking news, momentum, and chart setups. A scanner helps narrow thousands of stocks down to a focused watch list. But finding a moving stock is only step one. The real question is, can I define the entry? Can I define the exit? Can I control the risk? And can I test the setup? If I cannot define the trade, I should be careful risking money on it. Before day trading strategies, day traders usually talk about four main strategies: scalping, arbitrage, high-frequency trading, and pattern trading. Scalping means taking small profits from many quick trades. But retail traders are usually slower and face more trading costs than professionals. Arbitrage means exploiting price differences between markets, but institutions dominate this because they have faster access and better pricing. High-frequency trading uses advanced algorithms and ultra-fast execution. That is not realistic for most retail traders. So that leaves pattern trading. Pattern trading means looking for recurring chart setups like breakouts, reversals, double bottoms, wedges, and trend continuations. This is where retail traders have a better chance. Because success does not depend on being the fastest, it depends on recognizing structure, waiting for confirmation, and managing risk. So here is the bottom line. Day trading is legal, but it is risky. It is not automatically gambling, but without a tested strategy and strict discipline, it can become gambling very quickly. Most day traders lose because they overtrade, ignore risk, or try to compete where professionals have the advantage. For retail traders, I believe the most realistic path is pattern trading. Use the right software, test your ideas, control your risk, and only trade when the setup is clear. If you found this video helpful, hit like, subscribe, and check the exclusive partner discount links for these tools below. Thanks for watching, and I'll see you in the next video.